Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, December the 16th, 2025. Apart from anything, this, of course, is non-farm payrolls day. So finally, we get quite a lot of data in the US. We get retail sales, we get non-farm payrolls for October, November. But really, November is the important one because in the prior month, there are a lot of problems with data collection. So the first thing is that the prior month maybe needs to be treated with a bit of skepticism, as Powell himself said. Let's just quickly look at the Bloomberg estimates here, and we see that for the headline number for the November period, so November period, again, we will be getting some numbers from October. So probably, as I say, some skepticism, but maybe as an agglomeration to get a general sort of sentiment. Let's keep an eye on October as well, but we don't get the unemployment rate. But for November, for the headline number, there's a wide dispersion of views. So you can see here that the median, even though the median is 50,000, you can see here that there's a very wide dispersion going all the way down to a negative print of minus 20,000 with a high of 130,000. So we have a dispersion here of about 150,000, and that's quite unusual. That's quite wide, and that is essentially saying that no one really knows. There's generally historically when there's that much dispersion, it means that there's a certain amount of guesswork happening, and that's due to the fact that we had the shutdowns, but also the data collection during the shutdown period was a bit sort of patchy. Nonetheless, it serves as a baseline. So what we have as a baseline is about 50,000. Now Powell himself said that, the old days of needing to have 150,000 jobs on a monthly basis created. To sort of keep the job situation stable. Perhaps that's gone away. We know that there's almost like, there's maybe even like negative immigration at the moment. There's certainly people being deported and not many immigrants, legal or illegal, are being admitted into the US. So the point is that the replacement rate, the number of, the supply is actually going down, which means that even without a very strong job creation, active creation, the unemployment rate can stay relatively stable. What I think actually is always kind of interesting and important to look at is, if we assume that this median, is roughly what the market is focused on, we can look at, of 50,000, we can look at one standard deviation as 30. So the point is here that what would create, sort of statistically for the algos, what would be considered, a strong statistical move? Okay, one standard deviation above would be, plus 80. Two standard deviations then would be plus 110. So 80 and 110 would be considered very, very strong, two standard deviations. On the other hand, on the downside, within one standard deviation, which is kind of normal variance, would have, let's say, something between 20,000 and 50,000, and I think actually that's what the market wants. And then a second standard deviation would be actually a negative number that would start to get into a second standard deviation, which would be minus 10,000 to plus 20,000. So minus 10,000 to plus 20,000 would probably be considered weak. Okay, so if we actually look, let's just look and see just some of the other numbers here. So hold on, where are we? Just give me a second. Got a lot of stuff up here. Yeah, so apart from that, so let's just have a look at what the other numbers which are expected here. We're expecting the unemployment rate here. Where are we? The unemployment rate to be about 4.4%. If I can find, unemployment rate previous was 4.4, and the consensus here is for 4.4 as well. Now, keep in mind that the SEP, the Summary of Economic Projections, which the Fed released last week, their updated sort of number for the unemployment rate for 2025 was actually a little bit higher. It was at 4.5. So, that would be a little, I don't want to say a shock, but it would be sort of maybe unwelcomed by the Fed, for example, if that were to get up to 4.5. So that's the second thing we need to be looking at. The other thing as well, of course, is the number for the average hourly earnings. Now, the previous was 0.2, so, fairly sort of benign. The consensus, is maybe a little bit higher, 0.3, something like that. But again, what we're looking for is, this monthly number. So let's keep an eye on the monthly number. Participation rate's also going to be an interesting one. This is in the context of Powell talking about the pool of available workers, so the supply of workers. And the general narrative has been that since Trump's aggressive immigration policies, the pool of participants, people potentially available to work, is shrinking, and that's maybe keeping the unemployment rate at a good level, not sort of going up too much. So that's all of that. Just while we're here, the other thing which I think actually might be incredibly important as well, or very important, is also going to be retail sales. So keep in mind that we get the retail sales. And again, this is slightly lagging data. Note the month here, October. Here we are in the middle of December. So this number is definitely an old number. Now, I'm not going to say it's a sort of a waste of time or anything like that, but the point is, it is a slightly lagging number. Now, in terms of and then that's going to be important just to see, what the American consumer is doing. Although it's only goods, doesn't really include services and whatnot. So let's keep an eye on that. As usual, the important number is going to be the retail sales, excluding automobiles and the control group. That's it. If you look previous to that, it's meant to be, a little bit stronger than last time. So just in terms of the employment as well, if we look at some of the proxies, I mean, it's been a little bit mixed. If we look at the private survey of Revelio Labs, which a lot of people are looking at, that actually saw losses in October and November. So that was a little bit of a negative. On the other hand, ADP and JOLTS numbers, there were some positive facets and some negative facets. So I would say that overall ADP and JOLTS was a little bit mixed. And then if you look at the initial jobless claims, apart from a couple of hiccups, that's essentially been, around about 210, 220, sort of 4-week moving average. So that is actually indicating a strong workforce. So, what can we expect today? If we add, let's say, 40, 50,000 jobs, that would be, I would say, in consensus. So I would say the general consensus is for a slightly weakish number, technically about 50,000. But what does the market want? So let's just see also just in terms of the effect on the Fed. Now, keep in mind the Fed obviously cut last week. A lot of people thought that Powell was relatively dovish. But in terms of what Powell said as well, it's important to understand that Powell also said that the Bureau of Labor Statistics data, and this is a quote, may be overstating job growth by 60,000 per month. Just think about that. Powell himself was saying that the BLS numbers may be overstating by 60,000 per month. So the point is here is that if we get, let's say, a print, the median expected is 50,000, in Powell's mind, that could be actually a negative number of minus 10,000, because Powell thinks that statistically, the BLS numbers are the BLS is BS kind of thing, excuse the French, but maybe be overstating. So what's going to be interesting is just keep that in the back of the mind that any number that the Fed and Powell may be looking at that and subtracting 40, 50,000 in terms of where the real state of the labor market is. That's just an important one to keep in mind. Okay, so let's just look and see what the market's pricing here. So we know we got the cut. So now we're in this range here. The Fed funds rate is targeted between 350 and 375. So in terms of January, the market is still a bit skeptical and essentially is three quarters, 75% probability in terms of market pricing of staying on hold. But if we go all the way out until the end of December here, you can see this is the last meeting. I mean, obviously there's a range of probabilities, but compared to where we are now at 350 to 375, the market for the end of December is pricing that the most probable outcome is this one here, which is 2 cuts. So the market statistically, I mean, there is still a 25% chance of 3 cuts or maybe only 1 cut, but sort of the medium here is for 2 cuts. So let's just simplify it and say that the market is expecting 2 cuts. So still a bit more sort of dovishness to come, so to speak. Whereas the SEP itself, the Fed themselves, they remember on the dot plot was only for 1 cut was the median number, only 1 cut. So there's still a little bit of a gap between the market. The market is still technically a little more dovish in terms of the forward pricing than the Fed. So it would require, quite a weak number, in my humble opinion, to really move the front end of the curve a lot. So in terms of some stuff, let's just look. I mean, what could the market do? I would say, just looking at a few sort of charts here, if we look at the front end of the curve, so let's look at some of those yields. Where are we? So let's say the 2-year yield. So yeah, so you can see here that after the Fed cut on last Wednesday, the yields went down, and ever since then, yields have come down quite a lot. We can actually quantify that. Let's have a look. Since the Fed, yields have come down more or less about half a cut. Okay, so 12 and a half basis points, which would equate for 1 more half cut. So the market has essentially priced in, one extra half cut, 12.5 basis points since the Fed came in. What the market is, I would say, is not really pricing in is a kind of a recession, any kind of sense of recession. There's a general sense that the labor market is okay. It's relatively robust. It's not hiring enough, but it doesn't need to hire enough because the supply of workers is not huge. It's also not firing a huge amount. And there's also a general sense, if you read the comments and whatnot, and look where the stock market is, that the Fed is going to cut another at least once, maybe twice or even three times, depending on the politics. The stock market is strong, and going into the midterm elections, the general consensus at this point is that the Trump administration will sort of pump the economy and boost the economy. So all that to say that what is not really priced is a recession. And what does a recession look like? A recession looks like a much more aggressive slowdown and weakening of the labor market. So let's say, for example, today, rather than getting an unemployment rate of 4.4, we get something much stronger, 4.5, 4.6. We get maybe a higher participation rate. Maybe there actually are more people looking for jobs. And of course, if the headline number, comes in sort of negative or, minus 10 or minus 20,000, and keep in mind that Powell himself thinks that number is overstated, suddenly the market could start thinking, this real number, quote unquote, is more like, minus 20, minus 30, minus 40,000. That could get the front end to sort of push down those yields a little bit. And maybe all across the curve, because we have been seeing, quite a lot of steepening, all things considered. You see the 2s 30s curves very steep. If you look at the 2s 10s, the curve's very steepening. So that's an interesting one. So if we get a very weak number, we could still see even maybe a little bit more steepening, but this time it would be front end led. Sort of a bull steepening. So that's an interesting one here. On the other hand, and of course, if we get a weak number, that would probably force the US dollar, weaken the US dollar, especially I would say something like the Japanese yen, because we know that we have 80-90% chance of the BOJ hiking in a couple of days. So if we look at the yen, you can see that the US dollar has been weakening against the yen over the last 4 or 5 trading sessions. If we were to get a weak number, I think obviously the US dollar in general would be hit, but I think the yen would be a good candidate to really just sort of kick down a bit more, maybe to this Fibonacci level, 153.7, something like that. Same thing here in Europe. You see here the euro continues to grind higher. So overall, the dollar is showing some structural weakness. There's like debasement fears and everything. A weak number, a very weak number today, by which I don't mean 30, 40, 50,000. I mean 10, 20,000 or zero, something like that. That could really cause some quite significant dollar weakness over the next period. On the other hand, if we look at sort of strength, what could like a strong number do? This is where it gets interesting because, as I say, the market, the vibe is that Trump will pump the economy in 2026. The Fed is generally on side. Whether it cuts once, twice, maybe 3 times. Okay, generally it's going to be supportive. We have a bit of QE light, so to speak, with the 20, 30, 40 billion dollars per month of purchasing of treasury bills and whatnot. So there is generally a strong vibe. If the sweet spot is probably something which shows a slowly weakening, slowly cooling labor market, what would that look like? If we consider that the replacement rate is we need like 30, 40, 50,000 jobs. If we get something like 25, 30, 35,000 jobs, that would probably keep the equity market very happy because that would be not strong enough to cause the Fed to really sort of pause. And that would also, but not weak enough to signify the necessity for dramatic rate cuts because of a recessionary kind of vibe. So what we want to avoid, when I say we, I mean the equity market, is to avoid any sort of hint of a higher probability of recession, but also on the extreme, you certainly don't want a plus 120, 150, 100,000 jobs, which would cause, maybe the market pricing to price out, January, maybe March pricing would go, let's say, from 2 down to 1.5 or even 1 cuts. The equity market would not like that. So I think the equity market wants just that sort of a sweet spot in the middle. If it gets too strong, we could see a little bit of a sell-off in equities. So the equities just wants a nice sort of, too strong or too weak. Any extreme 1.5 or 2 standard deviations, those numbers I mentioned at the beginning of the market would not be great. Now, just in terms of volatility, we've seen the VIX Had a little bit of a push up the last couple of days up into 16, 17s. It's not its lowest levels, but if you look historically, it's at quite low levels. And we can just see what I want to do is just look at the pricing today. So let's just go on to, I've got the interactive brokers here. So first of all, just see, I'm taking the March contract, so almost rolling over into the March contract for ES. So just using the ES as a proxy here, you can see that the percentile very, very low, pretty low, and the 52-week implied volatility ranking. So we're at low levels of implied volatility, which is unusual for a non-farm payrolls double dose. So here's the option chain. So I've got the 0 DTE. So let's just see what's going on today. Let's put on a straddle. We'll actually just look at the straddle. So if we just take let's say that with the 46 delta on the calls, and which would be equivalent to the 53 delta. So basically at the money, if we put that in, you can see, hold on, why is that not, that should be pricing for, oh, let me just reset this maybe, price it for a straddle. So if we put that in, that should, okay. There we go. So we've got the straddle here. So as you can see, it's a basically delta neutral, the one-day straddle. And we see that it's going to cost about 40 points, so about 160 ticks. So 40 points, if you actually look at that just in terms of the percentage, it comes out to about just about 60 basis points. Let's just do the maths here. So 40, we're going to divide that by, let's say 6880, 6880. And make a percentage. So we're getting to about 58%. So about 60 basis points here, which is pretty low because often, on Fed, let me just clear this, on Fed days, obviously, but let's say non-farm payrolls, typically you might see over 1%, 125 basis points. So basically here, as you can see here, the straddle is just being priced for about 40 points, which is quite low. So if we just put that back onto the chart, just to give you a sense of what that looks like. Again, that was for the March contract, so it's not exactly the same. It's a little bit different, but just to put that into perspective, what a 40 basis point sort of move looks like for the straddle, that is, sorry, not 40 basis points, 40 points. There's 46 points. So you see, we're talking, the market is only expecting a very, very low volatile situation here. So there's 40 points below and there's 40 points above. So a very small range. So that means that in order really to get the market moving, we'd have to see a fairly extreme move, which would sort of uncouple and destabilize that option pricing. We would have to see, as I say, probably a 2.5, 3 standard deviation sort of number. And okay, so also the way to look at this, apart from all of these numbers, keep in mind the average hourly earnings, very, very important in terms of the Fed as well. Obviously, if we get a low number, that would be sort of bullish, that would be dovish. The Fed might be more comfortable about inflation. What the equity market and the market in general would not like would be a very hot number, plus 100,000 on the headlines and an average hourly earnings +3, +4 with very strong retail sales. So we need to put it all together. We also have service PMIs. I think we also have the PMIs coming up later as well. Yeah, at 9:45. So we have the flash PMIs, the S&P Global. So that's not the ISM. Which is, sort of the gold standard, so to speak. But we also have at 9:45. So it's going to be a busy period of just looking at the data. So let's also look at the what's expected here. You look at the composite. The previous was 54, forecasted 53, so still above 50. Then if you look at the manufacturing, 52, and the services 53. So everything is expected at 9:45. For the S&P Global sort of PMIs. So that's the point. The market will take its direction going into Christmas. Obviously, we have the CPI in a couple of days as a combination of average hourly earnings, the headline number, participation rate. I think it's going to be, well, for me personally, quite interested. But really, the retail sales and then the service PMIs. We need to put that all together and just to see whether this sort of dominating narrative that the Fed is relatively supportive, even slightly dovish, and the economy is relatively robust, strong enough to power through, plus Trump stimulation. That's what we're going to need to see if that's going to be confirmed in the next couple of hours. Okay, guys, I'll leave it there. Have a great trading day, and we'll be back tomorrow to have a look at all this as well. Thanks very much, and have a great day.